Wall Street legends, tech insiders, a member of Congress, and even an NFT manager. Insider trading has left a trail of prison sentences, billion-dollar fines, and one stunning FBI wiretap. Today, the biggest insider trading scandals, how they started, how they were caught, and who actually paid the price in under 6 minutes. Stay to the end. Quick definition, insider trading is buying or selling a security based on material, non-public information. If it's material, meaning a reasonable investor would care, and not public, and you trade on it or tip someone who trades, that's illegal. Ivan Boesky, once a superstar arbitrageur, was caught paying for inside tips. He paid a then-record $100 million in fines and cooperated with authorities. His greed is all right speech became a cultural moment and a warning shot. Mickelson, the junk bond king, was later charged with securities violations related to the same era's trading culture. He pled guilty to securities and reporting violations, served time, and paid hundreds of millions in penalties. The Gambler and the Golfer. Sports bettor Billy Walters received confidential tips about Dean Foods from a company director. Walters made tens of millions. He was convicted in 2017 and sentenced to prison. Golfer Phil Mickelson, who traded on one of Walters' tips, wasn't charged with a crime, but disgorged about $1 million in trading profits in an SEC case. The Imclone moment, Sam Waksal and Martha Stewart. In 2002, Imclone's CEO Sam Waksal learned the FDA would reject a key cancer drug application. He tried to dump his own shares and tipped family. He was sentenced to over 7 years and paid millions. Martha Stewart sold Imclone shares after her broker passed along a tip related to Waksal's selling. She was convicted of obstruction of justice and lying to investigators, not insider trading, and served prison time. The public learned a critical nuance. Even if you avoid trading charges, lying to investigators can be a felony. The wiretap era, Galleon and Raj Rajaratnam, then came the Galleon Group. Raj Rajaratnam built an empire on technology stocks, and, according to prosecutors, a network of insiders. In a rare move for white-collar cases, the FBI used wiretaps. Jurors heard Raj discussing Edge. He was convicted in 2011 on multiple counts and sentenced to 11 years. One of the longest insider trading sentences in U.S. history, with massive forfeitures and penalties. The case sent shockwaves. Wiretaps weren't just for mobsters. They could be used for hedge funds, analysts, and executives. After Galleon, insider networks, expert networks, consultants, friends of friends came under intense scrutiny. The biggest checkbook, SAC Capital and Mathew Martoma next. Prosecutors turned to SAC Capital, one of the most successful hedge funds on the planet. Multiple SAC portfolio managers were charged over time. The blockbuster Mathew Martoma, who traded on secret drug trial data for Ellen and Wyeth, was convicted and sentenced to 9 years. In 2013, SAC Capital itself pled guilty to insider trading charges and agreed to pay $1.8 billion in penalties. The fund returned outside Capital and later re-emerged as Point72, Stephen Cohen's family office. Corporate insiders in the digital age. Apple, Amazon, Equifax. It's not just hedge funds. Corporate insiders get caught too. Apple, Jean Levoff, Apple's former senior director of corporate law and a co-chair of its disclosure committee, was charged with insider trading tied to Apple earnings. He later pled guilty. A brutal irony. The lawyer helping enforce Apple's trading policy was violating it. Amazon. A former Amazon finance manager and her family traded ahead of earnings announcements and made over $1.4 million in illegal profits. One family member was sentenced to prison. Equifax. In 2017, while Equifax quietly investigated a massive data breach, a technology executive sold shares before the news went public. He was sentenced to prison. A politician crosses the line. Chris Collins sat on the board of an Australian biotech. He learned, while at a congressional picnic, that a key drug trial had failed. According to prosecutors, Collins tipped his son, who sold shares, and family and friends avoided losses. Collins pled guilty to conspiracy to commit securities fraud and lying to the FBI. He was sentenced to prison and later received a presidential pardon. Insider trading isn't just for stocks. Coinbase. In 2022-2023, a former Coinbase product manager leaked upcoming token listings to his brother and a friend. They front-ran the market and made profits before listings pumped the coins. Prosecutors charged wire fraud conspiracy, calling it an insider trading scheme, and in 2023 he was sentenced to 2 years in prison. OpenSea. In 2023, OpenSea's former head of product was convicted of wire fraud and money laundering. He used confidential knowledge of which NFTs would be featured on the homepage to buy them first, then sold after the spotlight drove prices up. He was sentenced to prison. How they got caught: wiretaps and recorded calls, emails, DMs, and metadata, trading pattern analytics, unusual profits before news. Individuals go to prison, firms write giant checks, reputations vanish. But the bigger cost is trust. The idea that markets are fair, never trade on material, non-public information, follow blackout windows and pre-clearance rules. Don't share confidential info, even just a hint. When in doubt, don't trade. This was every major insider trading scandal explained in 6 minutes. If you want a part 2, lawmakers, the Stock Act, and the gray areas, hit subscribe.